So if you've been following the news in the Amazon aggregator ecosystem over the last couple months, which is really these large companies that have raised $15+ billion to buy up smaller and medium-sized Amazon brands. And the news honestly hasn't been the best. We had Thrasio, which is the foremost leader in the Amazon aggregator space, both in terms of size, money raised, assets acquired. They had a massive reorganization with about 20% of their staff being reduced. We've also seen some of these smaller upstart aggregators flounder and actually get acquired by other larger Amazon aggregators. So what does it all mean? Why did it happen? And ultimately, as Amazon sellers and for the Amazon ecosystem, what are the implications? We're gonna dive into all that in this video. So I wanna first dive into what I think are the actual structural flaws in the original version 1 of the Amazon aggregator playbook. The first is, I think, this fallacy between the digital and traditional retail shelf space. So if you think about traditional retail, right, imagine you were selling jeans into Nordstrom or a big box retailer. There's a finite amount of space that you can actually place jeans in that store. And so if you actually get that spot, that shelf space, it's very, very durable. It's hard to knock you off. Similarly in grocery, right? If you're a Procter & Gamble and you've got 3 of the leading dishwashing detergents, that space is gonna be one section of the store. There's probably only 6 to 8 brands that can be in there. And if you dominate that, you put your media buying behind that and you have a brand and you've got that distribution relationship with the buyers at these big retailers with hundreds of doors, it's really hard to supplant you and it's pretty guaranteed space. But the digital shelf space is not that. Even if you've got an Amazon listing with 20,000 reviews and it's been top 3 in organic search for 5 years, there's a lot of dynamics at play that make that less durable than the traditional shelf space. It's very product offer based versus brand based, which is traditional retail. It's also very algorithmic versus human. It's a mathematical equation that's deciding it, not a buyer that you may have a relationship with or a figurehead of purchasing at one of these big box retailers. And then finally with Amazon, there's ad dynamics at play too, right? There's been an increasing amount, especially the last year, of the actual available real estate on the homepage of search for a particular search term that's actually driven by ads. And surprise, surprise, the number of organic placements has actually shrunk significantly. So imagine you were in traditional retail and all of a sudden you had to pay for 15, 20, 30% of your sales. It's a significant margin erosion, and I think something that the aggregators didn't take into account. The second is this thesis around being a growth company or just the mathematical reality of running physical product brands. You know, if you look at a SaaS company, which is where a lot of the venture-backed startups come from, the incremental cost of adding a new user to a software platform is minimal, like less than 10%. So these were heavily staffed organizations with lots of programmers, lots of business development and marketing people to generate leads, because that cost of OpEx was pretty small incrementally in terms of the overall organization and the overall costs. Physical products are not that. There's real world working capital needed to buy all this inventory, to ship it, to manage it, to have the staff to oversee it, to pay for advertising, to account for supply and demand changes. And said another way, if you bloat these organizations, it's not like a SaaS startup. You don't have the margins there because there's a heavy working capital constraint. And so I think a lot of these aggregators staffed for economies of scale, thinking that they were more of this hyper growth SaaS oriented VC backed startup, and that they would get economies of scale with all these functional groups that were built out. And then at some point you would get this real benefit of having this engine of people that could drive all these brands. And if you added one more brand, it wasn't a whole lot of incremental cost. And while that can be true, and I think it can play itself out, I think one of the fallacies, the structural flaws in this first phase of the aggregator model is that you're acquiring these mom and pop brands, even those that are doing 10, 15, $20 million, that have a sliver of operational expense. So one could argue that all of the optimization in terms of OpEx has already happened because they're already really minimally staffed with not a lot of headcount burden and all the costs that are associated with onshore staff. And then you get these aggregators that are based in New York, that are based in California, these centers where you actually have to pay pretty significant cost burn to get high class talent. And they're flooding their organizations with this, and then they're dumping these brands that have really small OpEx on top. And I think frankly that there was just a working capital constraint from that OpEx where economies of scale have simply not realized themselves in reality as they were on paper. The third structural flaw for me is actually valuations. So I think as things became really frothy in the fundraising environment, and you know, there was another one that raised 100 million, another one that raised 200 million, You had dozens and dozens and dozens pouring into the space along with big money to support that. There was a lot of undue pressure to grow that bottom line EBITDA inorganically, get as much debt, as much equity as possible, and chuck as many brands as humanly possible into this organization such that when you raise your next round, the valuation was higher. And it becomes this hamster wheel where if you're not acquiring quality assets at a fair valuation, it can catch up to you really quickly, especially if there's headwinds. So I personally think that Amazon brands, for most of them, shouldn't be more than 4x multiples. A lot of them, frankly, should have been 2.5 to low 3 multiples. And in this frothy environment, these brands were getting acquired for 4.5, 5, even 6 times valuation. And when you pay too much for an asset, you're not going to be able to grow your underlying cash flows and asset EBITDA. And then for me, the fourth flaw is really this idea of true EBITDA growth. And I think if you look at any business management class that looks at mergers and acquisitions, what they'll tell you is they rarely work out. It's one thing in a spreadsheet to account for everything that's going to happen. When reality hits and you talk about cultural integration, bringing in staffing, systems, people, processes, understanding the business that you've actually acquired, it's pretty difficult. And it's definitely more difficult when you're acquiring dozens and dozens and dozens of brands a year. Some of these aggregators were acquiring 100+ businesses a year. And that complexity made it such that it was very hard to integrate them from an accounting standpoint. And I think this was a major reason that Thrasio had a difficult time going public. But more importantly than that, it's very difficult to track, are you actually growing or not? Obviously, as you acquire businesses, your underlying EBITDA is going to grow. But each of those individual assets may be declining even though your overall portfolio is growing as a whole. And at some point that catches up to you. The rubber hits the road, you get year-over-year comps, and you start to see when that lack of asset growth happens. And I think that fallacy of chasing that bottom line growth at all costs to raise more money caught up to a lot of these aggregators. So let's talk about why the cracks emerged. I think the first foremost one is the fact that a lot of these businesses were acquired on the back end of what would have been their highest ever 12-month previous earnings potential. And that's because of COVID, right? We saw an influx of shopping online. A lot of these brands 5, 10x their growth. When they were purchased on the very back half or the peak of that, even the best operator in the world with the best systems is not going to be able to grow them. It's just there's not enough demand to comp that growth. And while I think a lot of the aggregators obviously are going to work that math into it when they're buying the businesses, I don't think they worked into the math enough on how hard it was to actually maintain that stability or even grow those brands. And again, when you're overpaying for them, and you're paying 4, 5, 6, 7x what that highest ever period was, and you're not effectively accounting for how it may go down, you've got an asset that you've wildly overpaid for. The second thing that I think led to some of these challenges are just really misunderstanding the organic durability of these brands in organic search. Again, just because you have 20,000 reviews, just because you were top 4 organic forever, doesn't mean that things change. New offers come out, new brands come out. Amazon changes their search algorithm. Amazon dramatically changes the amount of editorial placements, of recommendations, of ad slots. And all of that meant that you might have had a significant more free eyeballs historically for a particular ASIN. And because of the change in SERP, that's simply not the case anymore. And unlike traditional retail where you've got this peg forever, it's just not the case in an Amazon environment. The third and pretty obvious one is all of the supply chain constraints and issues that developed here over the last year. Obviously, costs have gone up dramatically at the factory level, but worse than that, it was very difficult to match demand and supply because of the challenges with the transportation environment. And we had container costs going from $3,500 up to $20,000 plus. And worse than that, what used to take you, say, 20 to 25 days to get a product from China on a boat to California, we had 20, 30, 40 plus day delays. And if that resulted in a stock out, you have these assets, again, that you paid 4, 5, 6x for that don't have sales for a 6-week period. So it's a dramatic pain point through these supply chain disruptions and these cost increases that pinched everybody, including the aggregators. And then the final thing, which I don't think a lot of people talk about, is just really hard to grow with complexity. It's difficult to hire and integrate over 100 people. It's difficult to integrate, buy, and seamlessly bring in dozens and dozens and dozens of brands while you're growing. And it's very, very difficult for your organizations to develop a playbook and to learn on the job. I've said this before in a lot of my historic videos, but you need to earn an Amazon degree. And it's not so much about intelligence. It's not so much about your previous experience in other realms. Those things help. But you've got to be in the trenches, you got to get your war scars, you got to get your bloody noses, and frankly that just takes a couple years for most people to get. And so these organizations had to get their Amazon degrees on the job while they're raising hundreds of millions of dollars, while they were trying to grow dozens and dozens of brands that they integrate, while they were trying to hire a crap load of people, in an environment where the previous year was a lot easier than the year that they were in trying to grow these assets. So I think that growth complexity was likely underestimated and was a significant burden on those trying to grow these businesses. So an important question, what the heck does this mean for the Amazon seller ecosystem, and what does it mean for you as an Amazon seller? Look, I don't have it all figured out, but I just literally came back from New York. I'm pretty friendly with a lot of those in the Amazon Aggregator ecosystem. I'm really incredibly proud of what a lot of these companies have built. It really is a unique moment in business history. But my take on it is that, you know, we're gonna have some winners and losers like anything, right? I think that those aggregators that have looked at those structural issues and managed them the best, I think the ones that had a playbook and a strategy up front that didn't have a lot of those fallacies in them, that paid the right valuations, that were patient with their money, that were patient with hiring, that understood how important it was to manage risk when they purchase something up front and understand how they manage risk within their organizations. Those are the ones, if they've got money, that are gonna come out of this in a really good spot. They're gonna continue to be able to raise money because there's still a ton of mass market demand from the investor environment to dump money into this ecosystem because it is one that works. But they're gonna dedicate that money to the winners and the people that have figured it out. And so I think that those aggregators that haven't been running properly, they're gonna be on thin air, right? They're gonna have a finite amount of money. It's gonna be more difficult for them to raise money. I think these ones that do emerge with cash are gonna actually be able to buy assets at their will. They're gonna be able to pick and choose. They're gonna be able to be more deliberate. And because it should be a less competitive environment as more of these other aggregators fall off of the ecosystem, they're gonna get a better valuation for those assets that they decide to choose to buy. The next thing, which we've already started to see play out, is these ones that have faltered and that kind of hit a wall and are unable to raise more debt and equity to sustain even their current operations, let alone buy new ones. I think they're going to start shopping, and then these ones with money and these other larger even PE organizations with money are going to be able to scoop up these aggregators for likely significantly less than what they raise money at, and likely less than what they actually purchased their assets for. So I think these struggling portfolios and brands will start to absorb, and we'll start to see that in mass. I mean, we've got 60 plus aggregators in the ecosystem. There's probably going to be somewhere between 5 and 10, I would say, over the next couple of years that emerge, and they're going to get folded into these organizations. Or there may be some offshoot strategies where people, you know, pick up these distressed books and try to turn them around and flip them. That might actually be a viable playbook for some people coming out of this. So you probably care a lot about this, but what the heck does it mean for actual Amazon sellers that are building brands like us? First, I'd say that these larger Amazon brands with, call it $10+ million in top line with multiple millions in EBITDA, that have real brands, that have real offers, that have a durable offer and value proposition in the market, I think that they're still going to be heavily sought after. I think those are still fairly rare to find. And even if there's only a handful of people left with a lot of money and able to make moves, they're going to be highly sought after. And I think that they're going to continue to go for a good valuation. Maybe not quite as much as it would have been 6 months ago, but they're definitely going to be highly sought after. So there shouldn't be issues with that. I would say the middle ground ones is where it gets a little bit more difficult. You know, if you've built a $2 to $5 million business, it's not a crazy brand, doesn't have a whole lot of differentiation, but is still doing pretty good. There's definitely going to be a market for that, but the days of getting a 5, 6, 7x for those kind of assets, I think, is long gone. I think that we're going to retrench ourselves back to what I would say is a true valuation, what it should have been all along, which is somewhere in that 3 to 4 range, likely landing somewhere in that low to mid 3 range. So there's still an exit opportunity, but you've probably lost 1 to 3x on what your actual exit potential was in this new world moving forward. And then I think the ones that are going to get hurt the most in terms of this exit opportunity are going to be those sellers that haven't quite reached scale yet, that haven't quite reached $1 million+ in revenue, and that basically just built ASINs, right? Nothing special about them. Maybe they're turning over 30 grand a month. They're the middle of page one. They have to rely a lot on ads. There's not a whole lot of differentiation. I think there's going to be almost no home for those, right? There might be some small-time buyers through sites like website closers and, you know, flipper sites and things like that you could sell for. But it's going to be like 1.5 to 2x, if at all. So I think if you've got one of those businesses, you need to be aware that the stark reality ahead is that you're probably not going to be able to sell, or you're not going to be able to sell for a whole lot of money. And so hopefully you get them to a place where they're actually cash flowing and it can be a cash engine for your life, but your opportunities for exit are going to be a lot lower. So that's it. Those are my thoughts, right, wrong, and different. We'll rewind the tape and maybe look back at this in a year or so and see how right I am. But that's just my take on it, right? I don't have all the answers, but I've been paying a ton of attention to this space. I sold my first brand to an aggregator. I've invested in the aggregator system. Again, I'm friends and know a lot of people in the space. And I think this is just part of the process, right? With new markets emerging, with new theses emerging, with new financial opportunities emerging, dynamics change over time. And I think that we're definitely seeing the world shift underneath us a little bit here. But I think coming out the other side, we're still gonna see an Amazon aggregator ecosystem. We're gonna still see exit opportunities for sellers. It's just different than it was before. So I look forward to seeing how it shakes out. I'm sure you guys will too. If you've got any more questions, drop them down in the comments below. Cheers.